The semiconductor industry is a very peculiar industry. In the semiconductor industry, you have to take all the money you've made and with each new generation of chips, you throw in all the money you previously made. So it's compulsory reinvestment of everything if you want to stay in the game. Naturally, I hate a business like that.
Today, folks, Taiwan Semiconductors is the largest single stock position I've ever taken on in my portfolio. My best buy price, $76 a share, and I've been riding the volatility that Berkshire has freaking been causing. Because if you went back to the second and third quarter of last year, not only did Berkshire load up $4 billion worth of the stock to only liquidate like 86% of it just a couple months later. Now we get some insight from Charlie Munger himself, the partner in crime with Warren Buffett, running Berkshire Hathaway, on his thoughts around the semiconductor space. And then he's going to reveal to us why he thinks the stock market's going to underperform moving forward. And I'm going to break all of this down for you. So if it's a conversation you'd appreciate, hit that like button and let's get right into this.
At Berkshire, we like a whole lot of surplus money to come in that we can do something else with. And of course, now if you're enough ahead of it, like Taiwan Semiconductor is, that may be a good buy at these prices. It's not at all clear to me that they're not going to succeed mightily, but it's a difficult. It's a business with enormous promise for the big winner, but it's a difficult business in requiring everybody to keep increasing the bets on and on with all the money. It's not perfect, that semiconductor business. Remember when Intel owned the world? Intel was once the Taiwan semiconductor business of the world. Yeah. They invented the damn business, and they dominated it for decades. And Intel, it's not clear to me that Intel's going to have a very decent semiconductor business, getting as far behind as they are now. My answer is it's not so damn foolproof as it looked. Look, it's not a field where I feel I have a lot of expertise. What the hell do I know about semiconductors? And by the way, it may be a wonderful investment. The fact that I don't like it because I'm an old man and I don't like learning new tricks, that doesn't mean it isn't right for some younger person that understands it better than I do.
So Charlie Munger really cleared the air on why they probably sold TSM, and it's primarily because they can't see the future in the semiconductor space. They're long-term focused investors, and in the macro here, TSM is way cheaper than any S&P top 10 company, has just as good, if not better, fundamentals than even the likes of Apple, but they just can't get past the long-term moat that they currently have. So I want to break that down for you very briefly, and my thoughts on what would make me sell TSM, because as it stands today, TSM is crushing it with their fab facilities. There's no other company out there right now that can keep up with the manufacturing techniques that they currently hold. And on top of that, they make over 50% of chips globally and over 90% of the advanced chips selling to the likes of Apple, Nvidia, even Intel, Qualcomm. They basically dominate the entire space. If they disappear tomorrow, the entire world would collapse with them. It's a huge security risk. It's why the US has taken incredible opinions and positions on what's going on in Taiwan Semiconductors by going there and trying to get them to build huge facilities in the US. However, TSM's entire moat is primarily based around ASML. These two companies have to work in parity together, and they have to maintain a really good relationship because ASML makes the primary machine that makes the fundamentals of the chips. ASML, what they've built is more advanced than anything on the moon, on the space station, anything NASA's ever done, and that's because they made a machine that can launch tin, a little piece of tin at 4 meters per second. They laser it to flatten it out. They laser it again, that explodes it into plasma light, at which they narrow that plasma light down to the 1,000th width of your hair, and they etch little transistors out onto a silicon chip, at which that machine is something that costs $250 million, and that's like the crappy low-end machine. The advanced ones are like $500 million, at which TSM will buy those machines, they'll make the silicon chips, and then build the actual functioning chip around that fundamental base, right? But the problem is ASML trades for a 43 times multiple. It's a very expensive company, but either one of these companies disappear tomorrow, the entire world's going to have a very big problem. I don't think there's a real reason to actually buy a semiconductor ETF except to de-risk yourself from the long-term prospect that Taiwan Semiconductors loses their moat, which I think is going to be very hard at this point. And it's the reason that I finally took a position in this company, because I think if you went back several years ago, predicting this kind of outcome would have been a lot harder, but I think TSM has got their foothold, and I think it's going to be very hard to disrupt it, especially with the contracts they're globalizing themselves with as it stands in this current moment. So honestly, yeah, something could change, something more advanced could come out. Yes, they have to invest constantly into future, technology. They have to buy these expensive machines. But the fact is even with buying those expensive machines, I don't know what Munger meant, because they have incredible cash flow. Their profit margins are incredibly high, and they free cash flow even after reinvesting into those machines. I mean, you take a look at the cash flow here, guys, and it's pretty astounding, right? But obviously they're investing this into growth. They're not investing it like Berkshire would, where you get the money and you go buy completely new stock. But that's not what any company does. You buy Tesla, you buy Apple, any of these companies, they're either just doing share buybacks or reinvesting into their business, right? This isn't like an investment business. So, you can collect the dividends, sit back, and the only thing that would make me sell TSM as it stands in this moment would have to be a fundamental pivot where we start seeing them losing their foothold or another company starting to make up more of the semiconductor space. So it's one that I'm watching for sure. But in this moment, you can't deny that it's probably one of the best buying opportunities of a lifetime in this moment. Same with the Chinese stocks, right? But I don't want to own BAB or JD and deal with the political prospects, because now China has no way of invading Taiwan after what happened with Russia and Ukraine. So I think we've kind of got the geopolitical stuff out of the way. But nonetheless, let's take the broad view of the market here and see what Munger was saying about why he thinks the general markets are going to start to underperform.
Why do you think everything else is going to do so poorly?
Because the valuations start higher now, and because government is so hostile to business.
And that's a view over the next 5, 10, 20 years? How far out are you thinking?
I would say it'll fluctuate naturally between administrations and so on. Basically, the culture of the world will become more and more anti-business in the big democracies. And I think taxes will go up, not down. So I think the investment world is going to get harder for everybody. But it's been almost too easy in the past for the investment class. It's natural that it would have a period of getting harder. I don't worry about it much because I'm going to be dead. It won't bother me very much when I'm just lying there dead.
Now, I feel as though there's a lot that he could have touched base on, because some of the things that are highly concerning me about the short term here has to do with the fundamentals that are breaking down in large cap companies, which could lead to some underperformance in the broader indices like the S&P 500, which over the last 5 years has been one hell of a volatile ride. It looks like we're still in an uptrend, but let's be real, things are expensive and things are slowing down. That's just a fact of reality that we have to face. We're not in this easy time anymore with zero interest rates and a flood of capital. These are conversations we've been having really in-depthly in my chat groups. You can join that by going to the Passive Income Investor Patreon page, where I've been posting videos basically nonstop all weekend talking about this stuff, breaking it all down for you. I'd greatly appreciate it. Less than a Starbucks coffee a month. I think I offer 10x the value. It's literally just $5 a month, guys. You can chat with me directly. I think it's an awesome tool. But let's take a look at Apple here first and foremost, because Apple, man, is one that I've been watching heavily. And for the first time, we're seeing Apple's fundamentals break down here. I mean, we're not seeing EPS growth now quarter over quarter. It's really fallen off for the first time since 2016, and yet the company is still able to hold itself at a 25, 26 times multiple. So my question is, how many quarters of slowing growth can we experience with these mega cap companies before people get tired of paying such a high premium for it? Like, let's look up Microsoft here. The actual revenue for something like Microsoft, let's say, Microsoft trades at a hefty premium, but when you actually take a look at the revenue growth, quarter over quarter represented the bottom line here, is it looks like it could go negative soon. It's fallen off a cliff in a way we haven't seen really since, 2017? Not sure what caused that initially, but my God, growth is clearly dying in mega cap companies for the time being. If that comes back, I think long term it absolutely will, but I'm hoping it presents better buying opportunities in the midterm. But you can't help but not understand why higher interest rates, how hard it has been to get capital, the fact that people's savings rates are down, they're clearly not spending money like they were, is going to lead to a slower environment in the market, which is why I personally think dividend investing is going to have a premium comeback. And we're seeing that with a lot of dividend stocks right now, whether it's the REIT, Starbucks, McDonald's, Pepsi, all these companies have been holding up very well. It's why we see the likes of SCHD doing very well, and it's why I'm going to be kind of adjusting my portfolio to be a little bit more dividend centric, which we've already seen. It's something I started pivoting into at the beginning of last year when I bought most of these dividend ETFs. But again, if that's a conversation you appreciate, consider subscribing. We'll talk about it more moving forward, but if you want to really continue the conversation, see my trades, know what I'm doing when it's happening, hit me up on Patreon, folks. I definitely appreciate it.